Hello and welcome. Looking forward to getting into chapter 1, and I want to begin with the accounting equation. As I mentioned in the introductory video, this is really kind of a basis for everything else that we're going to study in this course. So I want to define a couple of terms and then just kind of show you how this works. So I'm going to go in now and do some screen sharing here and get into Excel. Here we go. New tab. There we go. All right. So the basic accounting equation is algebraic in nature. It's very simple. It's assets equals liabilities plus equity. And you may hear the terms owner's equity if it's a proprietorship or a small business. That's the owner's interest in the business. Sometimes the synonymous term might simply be equity. Sometimes you may hear the term net worth, and that'll make sense here in a minute. But let's just back up and define some of these terms. So if I think about an asset, that would be something that I have that is valuable. You think about that. If I've got probably the most, we use the term liquidity, which means closeness to cash. The most liquid asset that I have is cash. There's nothing closer to cash than cash. So if I have $100,000 on hand, then I have an asset in the form of cash. I can use that cash to do whatever, spend it however I want to. Another type of asset might be equipment. It could be a vehicle. It could be a house. Anything that we have that's of value that we could then resell and convert to cash would be an asset. A liability can be thought of as a claim against those assets. And let me define that for a second. Let's say, for example, that I have a house that falls under this asset category, all right? And that house is valued at $300,000. Okay. And let's say that at the time when I purchased the house, I was required to put down a 20% down payment, okay? That means that I would have financed or taken out a loan for the remaining 80% of the balance, which means that if I take my 300,000 and multiply it by 80%, I then had a loan of $240,000. So it's true at this point in time with this house that I own a $300,000 asset. I have a $300,000 asset that's in my possession. However, I also have a $240,000 loan, which means I have a $240,000 claim against that asset, which means then if I was to define what I'm worth, if I was to find my net worth, what my actual value is as far as that goes financially, I'm going to take the difference of the two numbers. So I'm going to take the value of my asset minus the liability or the claim against that asset, and my true equity or net worth is $60,000. And that's really kind of how this is defined. So as I said before, it's algebraic in nature. If I knew any two parts of this equation, I can find the third. So for instance, in the same situation, if I knew that I had a $300,000 asset and I knew that I had $60,000 in equity, understanding how this formula works, if I have my assets and then I have 300,000 and I have my equity of 60,000, I can take my $300,000 asset minus my $60,000 equity and calculate the 240,000. And I could do that with any of the other two. If I knew my liability plus my equity, I could back into the 300,000. So it's all algebraic in nature. At this point in time, I need to always come back to a balanced number. So my assets must equal the sum of my liabilities plus my equity. And it does, 300,000 and 300,000. I guess I should have put that up in the other column. Oh, there we go. Now, anything that would happen subsequent to this is always going to still lead me to a balanced equation. For instance, if I, let me add some lines here. Let's say I make some payments, and in this example, I'm not assuming interest. So we'll just, for the purpose of simplicity, I get through the end of 1 year and I've made $10,000 in payments at that point in time. Now, assuming no change in the value of the house, just looking at the amount of the loan, I have a claim against the 240. I've reduced the 240 by $10,000, which means now that my new balance is 230,000. Okay. And in the process of doing that, I now own more of the asset. And one way to check this is simply just to add another $10,000. This is a very simple equation, so you don't have to necessarily do this, but you can always go back and check your math. In this situation, if I have my 300,000 minus my 230, I would be able to verify that it was 70,000. So in this case, after that $10,000 in payments, I now own more of the asset. It's still a $300,000 asset, but I now no longer have a $240,000 claim against it. I have a $230,000 claim because of the payments that I've made. And that's gonna, again, it's a very simple example, but that really is kind of the basis for everything else. And as we'll learn later in the course, we have temporary accounts and permanent accounts. These are what we call permanent accounts, these assets, liabilities, and equity, which means that at the end of an accounting cycle, whenever you prepare your financial statements and you close out a year, the balances in these accounts don't go forward. And let me draw on that for a second, or they don't cancel out, I should say. If I have a $300,000 house at 1 year, going into the next year, I would love to still have that $300,000 house. I don't want that to go away at the end of the year and affect my financial position. I wouldn't mind it if the loan went away at the end of the year, but we know that that doesn't happen. And we know that my net worth is going to continue going forward as well. For these accounts, after an operating cycle is closed, these still continue. However, we have other accounts, temporary accounts, which are revenues and expenses. Those do get closed out. And eventually your revenues and expenses land here. And so if you think about it, if this equity is translated into your net worth, and we've used the example of one situation, one house, where we've made a payment and we now own more of the house. Let's assume that I was a business, and during the course of the year, the income or expenses from my business flows through to my personal income and my personal wealth. Doesn't it make sense then at the end of the year, if I have made $100,000 in profit and I have $100,000 in cash as a result of business operations, that I now have the asset cash increased by $100,000. But because, again, I had, let's say very simplistically, I had $150,000 in revenues, and I had $50,000 in expenses throughout the year. And again, these are very simple examples, but for the purposes of illustration, that means that my net income is the difference of these two numbers. And if I'm claiming the income in my personal wealth, if I'm the business owner, then as my cash increased, so did my personal wealth, which means that now the sum of my assets is 400,000. The sum of my liabilities and my equity is also $400,000. The same would be true if I had lost money. If I had lost money, and let's flip these transactions really quick. Let's say my revenues were 50 and my expenses are, let's say 100. Oh, not 10. Don't forget your zeros. Then at that situation, in that situation, I had a net loss, which would mean that my cash is actually negative, or alternatively, I might have had a claim against that asset. But anyway, I'm decreasing cash, decreasing equity. So my total assets are now 250 and 250. Again, this is kind of an unrealistic example, but it does show you the effect. and you see how what happens on one side, what happens on this side has to balance to what happens on this side over here. I will say that when you're doing financial transactions, that you can do transactions that can be in balance, but technically be wrong. You could hit the wrong account and that type of thing. But I will guarantee you that if the sum of your assets, your liabilities, and owner's equity, if those two figures don't balance, then there is a problem somewhere. So that's at least one kind of initial checkpoint. If you go to the point and sum up your assets, it should equal the sum of your liabilities and an equity. If it doesn't, you've missed something somewhere. So that's a really critical thing to understand. That's it for today. I think that's a good general concept to get. If you have any questions, please feel free to reach out, and good luck. Thank you so much. Bye.